All right, Brett, how you doing today?
Well,
Doing good, guys.
Did you mute him this time? That's good. That's good. Hey, so anyways, you just posted a chart there. We'll see if Scott can click on that and get that up for us. But basically, you wanted to take a look and kind of do a recap and a little bit of a learn piece on the yen carry trade here, as you're seeing it become a potentially increasing aspect of the markets, particularly after last week's Bank of Japan decision.
Yeah, right. So the big point is last year, about this time of year, we started talking about the short VIX bubble and how it had the possibility to, at some time over the next, say, 4 to 6 months, to turn into something that could cause a kind of mechanical dislocation in a lot of different markets. And that ended up being right on target in that it happened during the first half of February. That's what that was. That's what the crash was that we saw from roughly the February 5th to February 8th or 9th. That was essentially a blow-up of the short VIX bubble. There was people trying to essentially make free money by using excessive leverage to multiply their returns in a low volatility market because they believed that the concept of it remaining a low volatility market was not a vulnerable concept. So it was free money to find different ways to take a very small return and turn it into a very big return by using leverage. And this kind of concept is something that plagues later stage bull markets. It's a consistent thing. It's why we get occasional dislocations. It's why we see things like what happened in 1987 on some level, certainly what happened in the late 1990s in terms of the Asian crisis and LTCM. Both of those things were essentially the same kind of thing. People didn't properly appreciate risks, and they didn't appreciate correlations, and they didn't appreciate the possibility that something that seemed very simple could lead to a big problem if everybody was trying to do it at the same time, and then it ran into an obstacle. So you see this when people have faith in the underlying fundamentals of the context. It looks like, well, since we're not going to be heading into a recession anytime soon, we can use exotic strategies to attempt to turn a low volatility market into big money. So that happens at different times and in different ways. And I think when you get to this point in a market like this, it's going to be kind of like looking at a bubble underneath wallpaper, and you press it down in one spot and it pops up somewhere else. And I think with the short VIX situation where everybody was shorting volatility instruments as a way to turn this market into something that could make them lots of money through the roll carry, eventually that blew up and it fed into other things, and it blew up all the weak hands all over the place during the month of February. I think that the next manifestation of that could possibly be in cross-border money flows, building leverage because of the huge differential between monetary policy regimes, particularly in Japan versus the United States. I think that's where the most obvious situation is. The United States has been hiking. We've got really strong performing assets. We've got a strong growth context. We've got fiscal stimulus. I think that you can deduce from there, given that Japan has been holding its longer end interest rates basically at zero for a long time now, that probably you put two and two together, people are finding, essentially the model for a carry trade, for those who don't know, is this. You've got a situation where the expected cost of capital in country A is extremely low, and the expected return on capital in country B is at least relatively high by comparison. And you can borrow capital from country A at the low cost of capital and use it to build leverage to multiply the expected return on investments in country B. So you're basically just playing that differential. And in the simplest form, it's just borrowing money from country A and lending it to country B. But there's a lot more to it than that. You can borrow and lever up and then use it to invest in, dividend-paying stocks or all sorts of things to play this expected and predicted set of relationships for just a money-making machine. And the more leverage you put into it, the more that machine makes you. And as long as something doesn't change about the underlying context, then that can really work. And so I want to just kind of explore some of the mechanics of that today and understand why that's possibly going to become a big risk now.
Do you also see any playing into the Bank of Japan's aggressive buying and JGBs and ETFs, do you think that that's also perhaps driven a lot of money from Japan overseas?
So yeah, I think
to find things to buy.
I think probably, yeah. In other words, the money that is domestically located in Japan has, that's always part of this process with the yen. What drives the value up is as the money starts to come back to Japan, because they don't need to feel that way anymore. They don't need to go to foreign markets to find some kind of return on their domestic savings, and it's generally speaking, a high savings type of economy. So there's two parts, though, where the Bank of Japan kind of plays into it. One, it's on that level that they have forced capital outside of Japan that could come flooding back. And two, that they have moved into such an uncharted territory that I think it's possible that they could start to think about the sustainability of, and I think we've already heard a little bit of rumblings of this, that they want to be able to keep stimulus in place. So the worst case scenario to them, they're not probably thinking about what I'm thinking about. The worst case scenario to them is that things start to go off the rails in terms of the mechanics of their program, and that they're forced to dramatically cut back on stimulus, which for them would cause a deflationary spiral in the economy. And that's probably their biggest concern. They want to be able to keep enough stimulus going to keep spiking the punch, to keep some kind of possibility of animal spirits going, and to keep some kind of inflation in play. And, if we get to the point where they've simply exhausted assets they can buy, they've put their banking system into a corner where it's just, unable to stay as an intermediary in transactions and still stay profitable without a bailout, they have to let some kind of a profit margin exist for banks, and they have to let the system, the financial system, exist in some way kind of outside of the bounds of captivity. If you think about like a nature preserve, and the bank is just starting to put everything into the zoo part, and there needs to be some kind of free assets out there in Japan that are working, and to keep it sustainable, to be able to keep doing that, they have to find new strategies now to do something that's kind of like tightening without tightening. And I think that they're starting to get nervous about that situation. And one of the little kind of rumors floating around, and they've kind of hinted at it a couple times this year, is the possibility of raising rates and keeping the asset purchases going at the same time. And it's difficult to see.
So where the U.S. stopped doing the asset purchases, they're talking about continuing to do that while they raise the rates.
I think they want to not change the net amount of stimulus, but still find a way to allow the banks to have a business model.
Yeah, it seems like the banks is the biggest concern for them, right?
Yeah, and the banks power the economy. The flow of credit is the number one force acting to create the upward part of the cycle, and they have to have a system that they can take part in that allows that to take place. So let's say I don't want to get too much into the central banking there. Just suffice it to say that it's possible that one of the strategies that the Bank of Japan will be forced into is on some level creating a net interest margin for banks in Japan, and that may mean raising rates. Now, at the same time, let's go back to the context I described a few minutes ago, where you've got this huge imbalance between the United States and Japan, and you've got this need to find new strategic ways, because with the VIX down where it is, with volatility as low as it is, yet predictability or seeming predictability of asset performance being higher, which is kind of the same thing, right? You don't see any big trouble coming on the horizon, but there's not enough movement in markets for small amounts of money to make big profits. So the natural tendency is to find ways to multiply those small profits through leverage. And that's kind of what happens at this point in the cycle. And one way to do that, and I can't imagine there's any way this hasn't been going on, is using borrowed yen at practically 0% to build that leverage to buy assets in the United States. And that's pure deduction on my part. I don't know that for a fact, but I think, given my experience, it's a very reliable deduction.
Let me ask you this, Brett, because there was that rumor that the Bank of Japan was talking about raising the rates twice while keeping the asset purchase going, right? I mean, obviously, It's funny because you see the average hourly earnings number from Japan this morning. That definitely had a big pop. So that's the inflation data you want to continue to watch. But I think we could agree that there really hasn't been any signs of any inflation picking up there. What has you thinking? If the Bank of Japan, if there's a threat, and it's certainly just rumored that they could raise rates, would you not be preferring to do a carry trade through Europe that's kind of laid out we don't plan on raising until after the summer of 2019?
Yeah, it's possible. So that's a very good point. And I was using the yen example as a launching point to point out, and yeah, I'm working on my chart book right now, and I'm exploring both the yen and the euro. And the way that we talked about it last week was with the idea that the differential between the United States and both Europe and Japan is vulnerable. And I guess I was more using the yen as kind of like a petri dish.
Historical marker.
Just to kind of describe the mechanics of it, because it could very easily be the euro. The yen, one of the interesting things is that they have done something strange, which is to pin the 10-year around zero. And that allows people to have more duration in you doing a carry trade, right? So that's a very odd thing to do. Europe, their interest rate targeting is all at the super short end of the curve, even though their asset purchases are along the curve. If you think about what's the most predictable thing, it's pinning the interest rate on the short end of the curve in Europe, and it's the long end of the curve in Japan. So it depends on how people want to structure that trade. But yeah, so the same risk applies to Europe. In both cases, versus the United States, they're just extraordinarily different parts of the cycle, and I think that it's that imbalance that's interesting. So, but no, that's a perfectly valid point. So let me just kind of quickly walk through the point, the reason why this is important to understand. So, what happens in this type of trade and building leverage in this way, you got to focus on a few different things. And one of the most important, there's two that people don't think of a lot. People think of the cost of capital in country A, and they think of the expected rate of return in country B. And they just kind of, look at those two concepts and say, is this or is this not a valid trade? And the mechanics of it are a little more complicated because there's also, as different factors, there's also the reliability of those expectations. How much, based on what you can assume it's going to stay like that in terms of the cost of capital and the expected returns. So there's volatility, there's demographics, there's the culture of the central bank, the way the central bank thinks and the people on the central bank. There's the volatility level that you find in assets, the volatility of interest rates, the volatility of currencies. Those are all really important factors in understanding how predictable it is. We can assume the trade is going to get much bigger, and this is going to be a much more popular strategy if those things are all seemingly very stable and predictable ideas. And in this case, I think that they very much are, or at least have been over the last year. As soon as the Bank of Japan announced this new curve control style of policy, and then when you really add in the fiscal stimulus coming in the United States with tax reform, those two concepts together have been playing out for the better part of a year, and they're probably factors that have been involved in making those things seem very predictable. And the demographics in terms of Japan is one of the most long-term, super predictable deflationary forces we have in the world. And the other really important factor that you have to remember is involved in this, and this is the big mechanical point, is the exchange rates. Because when you think about how the asset you're purchasing is going to perform, and you think about how the borrowing rate is situated relative to it, you also have to remember that when you're borrowing yen, you're then taking those yen and you're turning them into dollars, and then you're taking those dollars and then you're investing them in an asset. For the most part, that's the mechanics of it. And so the exchange rate itself is important because in theory, to ever monetize that position, you have to sell that asset, you have to take those dollars, you have to turn them back into yen, and then you have to repay the debt. So that step of translating it from yen to dollars and back to dollar to yen causes this big, crazy short squeeze dynamic thing that can go on that can really turn this into something that can generate a ton of volatility if a feedback loop gets started, and if this is a very crowded strategy. Because what happens
and
is
leveraged.
Yeah, if it's super leveraged up and crowded with lots of people who are all on the same side of it, then when it starts to go wrong, what you get is everybody trying to get out of the assets that they were investing in with the borrowed yen, and then trying to get the dollars back into yen. Because as the yen starts to go up from that pressure, and as the asset starts to go down, you get this huge double whammy to your capital exposure, because you're losing money in both cases, and it turns into this crazy short squeeze. So if you want to put that chart up, or if you have that chart, so that you can put it up, and if you don't, if anybody listening who's interested, you can look at the 1157 comment, and I posted a chart, and you can see, this is a good example of when that type of thing happens. This is the carry trade as it unwound during what we call now the flash crash. And I think everybody basically just thinks about this as if it was some kind of algorithm blow-up day where we found out that everything was just, computers talking with each other and market makers backing out. And it was just a weird mechanical flaw thing. But that's not really true. We like to package it that way so we don't feel like we worry about it or whatever. And so that, if you're, to the extent that you're trying to market investment strategies, you don't want the retail investor really worried about this sort of thing. So we don't like to talk about maybe what really happened. And what really happened was certainly in part a mechanical problem we had put too much reliance upon algorithmic factors in terms of making our markets. But what also happened was that was the first day when the Greek riots really got out of control, and when we heard definite threats for Greece to leave the EU, and nobody understood what the ramifications of that was. That was the beginning of that whole drama that day, and that's when we saw all over CNBC all day, we saw images of Greece, Athens just on fire. And that was also, as you can see, the green line in this chart moving higher, that's the yen. And you can see when it kind of went around, if you imagine a sort of, you can kind of see an exponential curve there. And if you think about where the shoulder of that curve is, when it went around that's also when the S&P, which is the black line on the top moving lower, that's when that went into free fall. And this is because at that time, we had a ton of money involved in this type of strategy. And as the yen started to squeeze higher and people started to worry about geopolitical factors, and we got that one big futures market order that started to go in and go to work, the bottom really fell out. In part, it's not entirely because of this, but this was a huge accelerant introduced into the system that people started to get absolutely brutalized who were in the strategy, because this was one of the biggest one-day spikes in the history of the yen and one of the biggest one-day declines in the history of the S&P. And they were happening at the same time, and there were lots of people that were long the S&P on borrowed yen. And it was a huge double whammy, and I'm sure we got more than a few people that just closed out their careers right in the middle of this. And it was an enormous phenomenon, but part of it, and my point here, is that the factor involved in driving the leverage was intimately involved in driving the panic. And I'm not trying to panic anybody about the stock market right now at all. This is, again, to go back to what I said at the very beginning, this is much like when we started to talk last August about the short VIX bubble and how it had at least the mechanical capacity to, at some point, cause something very painful that could be a really important market event that could either be seen as something that really hurts you or as a huge opportunity if you understand what's happening while it's happening. So just understanding the mechanics of this, I don't know if do you think that I've explained the basic underlying mechanics, Gav, at this point well enough?
Yeah, I think what will work for people is if we kind of do a step-by-step, which I know you laid out, but kind of using like not a real-world example, but exactly how it would play out, like what the hedge fund's doing, where they might be investing it, and perhaps laying out how it unwound back during the flash crash, so people get an idea of the A to D mechanics of what's going on. Does that make sense?
So you mean like let's come up with a hypothetical version of this being implemented?
You're a hedge fund trader, and
all right.
you want to do the carry trade in order to leverage, say, I don't know, a purchase in energy names.
Yeah, sure. And I would say, like, let's look at a good practical example is, you've got small movement and relatively stable markets right now with capital appreciation, with earnings growth, right? You got capital gains, and you also have decent dividends in something like a sector like that. So if you can feel pretty confident about that situation, and you're a fund with, let's say you're a small fund with $200 million under management, and you want to make a big splash because you feel really confident that this type of environment is going to persist. But if you just buy even-handed exposure in energy stocks that pay decent dividends, there's no chance that you're going to make 100% return. No matter what you do, you're going to have to lever your capital to make 100% return because those dividend payout rates aren't very high and the market volatility isn't very dramatic. So if you want to break in and talk about Tesla for a second, that's fine.
Yeah. So Tesla, just to give you a heads up, this spike here is due to a Financial Times report that Saudi's sovereign wealth fund is looking to build a stake in Tesla. So seeing a big spike here at 355 area. This is basically the spike we saw right after earnings. So that is behind the strict. What's that?
Was it Saudi?
Saudi, yes, Saudi Arabia.
There's a hedge on oil. Right.
I guess to a certain extent. I mean, they've been talking to the sovereign wealth fund there, moving away from energy exposure for a while now.
They own a bunch of solars too, I think. So
they do. So I mean, they get a lot of sun out there, so solar wouldn't be a bad secondary play for them for sure. And that would allow them to export a lot more of their product as well too. Right. So pretty interesting to see a big sovereign wealth fund like that take a stake here, though. So obviously the Tesla bears might be heading to the exit a little bit at this point, given the backing from big deep pockets like that.
Yeah, right. All right. So before we get distracted off,
so sorry about that.
Yeah. No problem. So we got our $200 million fund, and we've got a tremendous amount of conviction in a stable return situation for an energy portfolio consisting of high dividend-paying energy stocks, where we might see some capital appreciation from the equity, but we're really banking on the dividends, and we're banking on a lack of major downside to the equity. So we're able to basically say, we know there's not a huge risk of that biting in if we predict stable to slightly higher prices in the stocks, and we predict we're going to be able to take advantage of the dividends, then we know that we're going to maybe be able to make 7 or 8%, right, with our $200 million. But because we have so much conviction in this idea, and because we believe that there's just no chance of a recession anytime over the next year, what with the tax reform working and everything else, we want to turn that 7 or 8% into 60 or 70%. And the way to do that, because we have such conviction, we're willing to take this risk. It's not much of a risk because we'd have to be completely wrong about the whole environment to be wrong about this. The bigger risk is that we only make 6 or 7% on an idea that we just knew was right. So we need to find ways to build leverage. And there's lots of different ways to do that, but I believe that right now you can find the cheapest money to do that in Japan, and maybe Europe, but in Japan. So what you do is you borrow you invest, $800 million or $1 billion on your $200 million, or maybe more. And you put it all in this strategy, and suddenly you're making 20, 30, 40%. And if energy stocks perform better than you think, then you're making 60, 70, 80%. And this is a popular thing to do at this point in the cycle because people have a lot of faith and a lot of conviction in the idea that a sudden bear market that's, where the market completely falls out of bed, the earnings growth curve completely changes, the economic projections completely change. There does not seem to be much of a percentage risk of that looking out over the next 2 to 3 quarters, right? So that sense of confidence, even though there's not as much upside as there was years ago to this market, there's a greater conviction in at least some upside, and particularly in at least a lack of dramatic downside. And that means your tool is not about placing your investments as much as about leveraging them. And that leads to this tendency in later stage bull markets to get the occasional flashy, crashy kind of correction where it's very vertical, it's very dramatic, and it's very out of the blue because we've gotten to the point where everybody is kind of doing the same thing, and they don't realize that everybody else is doing it, and then something comes along that's unexpected and forces less reliability in those predictions, in those expectations, and so people start to cut back. And they do it together, and it's more dramatic of an impact than you'd think, and it feeds on itself. And then whatever other factor is involved can either be intimately related logically in that feedback loop, or can be escalating on its own. So if you think of the Greek riots and everything else. And in this case, you know, as I wrote in my notes this morning, that factor could be something related to the trade war. I don't know. But or the midterms, who knows? But some factor coming along
the fact
that
that
adds
it's
a little extra gasoline on the fire. And everybody's on the same
side. It's a black
side.
swan kind of cuts it off, right, Brett?
Yeah, I mean, you can get to something where people just, you know, they just weren't expecting, oh, this could change all of our big assumptions, and then they find out they're on the same side of the trade as everybody else. And, you know, I think one of those things in February with the short VIX bubble was really that when equities turned and started to go lower, bonds did not act as a hedge. And it was the risk parity guys who were kind of suddenly caught in this unexpected moment. And I think that helped feed on things until everybody leveraged up short the VIX, started scrambling for the exits. So,
and I guess it moves into your movie theater analogy.
Yeah, right. So there's this,
like
you know, if the movie theater has only 15 people in it, you know, it's not a very good movie. Nobody cares. And there's somebody, you know, lights a match and it hits a cup, you know, and everybody sees it, you know, people walk out, it's no big deal. But if it's overcrowded with people standing in the aisles and really concentrating on the movie and suddenly the thing flames up, you know, the problem isn't going to be anybody getting burnt, it's going to be the stampede. And that's the issue. There's only one little door, everybody tries to get out of it at the same time, and everybody's knocking each other down and trampling each other. And the same thing happens in markets when something gets too crowded and there's some unexpected match lit. And you know, I think that the where the Fed is going and where the U.S. economy is going, and the fact of our ability to use fiscal stimulus in the way that we have, and the political will to kind of draw forward growth, or draw future growth forward, pull it forward to the present, even at this point in the cycle, which is rare, is all something that compares to Europe and Japan and even other places in a way that suggests, given how cheap capital is there, that probably we have people starting to crowd up in a strategy like this. And you won't know for sure until it starts to go wrong.
Right. And then the basic steps is you'll see yen spiking up, right, which is another reason why it's a risk-off factor. Would you expect to see, what kind of moves would you expect to see in interest rates?
Yeah, so, I mean, and that's a great question, because obviously, you know, in previous sort of market landscapes, bonds would skyrocket in this type of situation because that is the safety asset. And I suppose that I believe that would still happen, even under current circumstances, because I think that once people saw, in February, one of the problems was it was the bond market moving down that was one of the reasons why things came off the hinges. And that could happen again. So it could be that happens again, and in that case, I wouldn't be sure. So if bonds moving lower is one of the reasons that causes people to reevaluate their feelings about maybe the cost of capital in the U.S. is too high suddenly, and it brings, you know, a little bit more risk of recession or into the near term, and people start to exit leveraged positions, et cetera, that could mean that bonds don't react to the upside. But let's say it's not that. Let's say bonds are flat between now and whenever some hypothetical yen carry unwind kind of move were to get started. My guess in that case is that bonds would rip higher, probably, because it would be a fear of a feedback loop on some level that certainly wouldn't seem to be inflationary.
Are there any asset classes that you'd be taking a look at as a potential canary in the coal mine here? I mean, the obvious is the yen, but like, is there any other knock-on secondary areas that you'd be keeping an eye out on that would have you taking a closer look at this trade?
Well, so first of all, I think that the way to look at this, so one thing is to understand that I mean, what was the value of understanding in advance things like the short VIX bubble? One thing that helped us do is we got short the stock market, I think on the 29th of January, when we felt sentiment data was over exuberant. We were past the FANG stocks reporting, and we knew this risk was out there. And we started to see the VIX kind of creeping up, even though there wasn't anything really suggesting it should be. And that kind of was a trigger. We got short the market, and it paid off well. But I'm not so sure that the best way to look at this is how to profit from the bad part, as much as it is how to understand that if that starts happening, number one, you're going to have a great trading environment for a few days as the VIX spikes up. Whatever it is, I promise you it's not the actual end of the world, and probably what it is an opportunity to profit from the bounce when the panic subsides. So there would be an initial cascading feedback loop of fear, of people not knowing what's going on, and if you have an edge, you understand, you see that it would appear to be that it's this that it's this big people running from the crowded movie theater because it was overly crowded. That doesn't necessarily change the fundamental course of the future for any assets, when you're looking at equities. It just means that there was too much leverage, and you need to watch that drop out of the equation. You need to watch that drain out. And then when it does, it's going to exaggerate. It's going to overshoot where things should be. And so just understanding that it's not actually, 1929, instead it's more like what we saw in February, and we got an enormous bounce out of that. It was obviously, if you look back on the charts now, in some individual equities, imagine if you had bought at the lows of that first tank in something like, an Amazon or whatever else. I mean, there's a lot of stocks where you can look at February as being, boy, if I was just buying into equities then. And I think this is probably not a cycle turn kind of factor. It's something where, too much pressure builds up and you let the air out. And
so it's more so like you said, right when you got on, you're not down on the market, you're not predicting this,
no.
But at some point it's inevitable that there will be an issue like this in a sort of flash crash, if you will. And and again, you're talking about the different instruments that you'd be looking at. Now, one of the things I know you look at a lot is the sentiment data, which I can't imagine, given the sentiment data, that you would feel that we're anywhere near close to a bubble at this point, do you? In terms of this trade, not talking equity market wise, you would have to see a little bit more complacency in bulls, I would think.
Well, so I'm not so sure that same sentiment data is going to look that way. I think the VIX may be a better gauge if we see the VIX back at 9. Just remember that it is about the sense of predictability, of extrapolating a lack of upside volatility in the yen and downside volatility in equities. And that doesn't necessarily mean people think the stock market is going to go to the moon. It's just that they believe that there's a very low chance of this turning into a suddenly, decisively different type of environment. And as long as it stays kind of like this, then there's lots of ways to find returns that you can lever up and turn them into big returns without needing the stock market to go up another 10 or 15%. Even if the stock market just goes sideways or creeps a little bit higher, that's kind of, I think, the environment that fosters aggressive leverage. So I don't know whether we'd see a big, it would obviously be better if you're looking at the short side of this idea, if you saw a lot of exuberance bake into the system first. But I don't know that it has to be that way before something like this could start to become a manifest issue.
Okay, one of our subs is asking, Brett, if you feel tracking some of the commitment of trader numbers for the 10-year would be a helpful read into this.
I would assume...
Meaning they're saying dislocation could lead to covering in the 10-year.
Yeah, right. I mean, and obviously, we've been almost perpetually at near record short interest in the 10-year and the 30-year for U.S. And I think that if you're trying to predict how the bond market would react, I think if you have an overcrowded short in bond futures, and again, like I said earlier, one of the drivers of the volatility isn't the weakness in the bond market, because I think that those people are going to be very unlikely to cover if they feel like the market is suffering from problems from them being too right. But if they're not getting paid on those shorts and it starts to creep higher, and then volatility, the VIX suddenly jumps to 30, the yen goes through the roof, then yeah, I imagine that's going to be a huge covering spike in the bond futures.
All right. So, I mean, this is going to be a great learn for people. I know we had a couple of questions about whether or not we were taping this. We do have a tape for this, and it's something that I would certainly continue to run over just so you could get comfortable with the terms. Brett, I know you've given people a lot to bite off of here, but what else would you like to add on to this subject?
So, I mean, I'll probably talk about it a little bit more here and there, like we did with the short VIX bubble idea. Understand the mechanics, understand the potential implications, and, kind of track, are we seeing any kind of signals? Because we did start to talk about it in mid-January, that it was kind of weird that we were seeing that the VIX, I posted a few times, hey, this is something where if the VIX keeps creeping higher, as the stock market keeps moving higher, it's one of those things where people might be starting to say, I'm levered up short this thing, a lot of other people are, and I might want to start reducing leverage, and eventually that fed over into reducing leverage long equities as well. And I think if we saw, the yen just start to creep higher in a way that didn't seem to make a lot of sense, then that would be another kind of signal like that. But, we'll try to monitor anything to see if we can see any kind of red flags related to this, and then occasionally kind of, understand, go back through understanding the mechanics of why this is an issue here and there, because my bet is, it's going to be awfully profitable at some point over the next 6 months or so, and maybe much sooner, but maybe not. I don't know. It's going to be really profitable to understand if you see this happening, to be able to take advantage of it.
Let me ask you one question, Brett, because,
Sure.
Obviously we saw a lot of this back around 2007 with the yen. What changes would you expect from now compared to the past that you think traders might have done to kind of, try to help them avoid past mistakes? Is there anything
I don't know.
You could think of?
So, I mean, the question is, I think almost the question is, has it been long enough that history can, really rhyme?
Right.
Because, the people who are populating trading desks, and probably a lot of people who are listening right now, were not trading in 2007. Probably the majority of people who are listening right now weren't trading in 2007. And so you got a lot of people occupying trading desks all over Wall Street who weren't even trading in 2010. So I don't know whether or not they've done an adequate job of education in a way that hits home enough, because a lot of times you have to get burnt by something before you avoid it. And I don't know how you could I don't think there's any way to structure an implementation of this kind of idea without being exposed to this kind of risk. It may be slightly different variations on a theme, but I think that once you're doing something roughly that is building huge leverage off of borrowed euro or yen and using that, to invest in assets somewhere else where return on invested capital is higher, I think that there may be slight differences in how you get burnt, but there's no way to avoid getting burned if it blows up and everybody's in the same thing.
Right. Okay. So, Brett, any closing points here for us?
No, I think that's good. I mean, we'll circle back around to this for sure, but yeah, I think we covered it.
Yeah, this is a very important topic of conversation, one that people really need to understand in order to understand the, exactly the correlation and what's going on in the market. So, Brett, thanks a lot for coming on and talking about this. Like I said, we are going to be posting a replay of this for people, and would certainly go over this a couple of times just until you get comfortable with some of the thoughts that Brett's put forward here.
All right.
So, all right, Brett, thanks for joining us, and we'll be talking to you shortly.
You got it. Thanks, Gav.
Okay, take care.